Every morning markets open with a single promise. Price discovers truth. That's the catechism. But for a tiny elite, truth is optional. Speed is everything. In the time it takes you to blink, an algorithm has scanned the entire order book, sprinted across cables and towers, and captured a penny you never saw. Repeat that trick across millions of orders, every hour of every trading day, and those pennies become mansions, planes, data centers. High-frequency trading doesn't win by knowing more about a company's future. It wins by arriving first. Milliseconds that mint money. This is where money, power, and history collide, and nothing is as simple as it looks. Markets are supposed to reward insight and risk, but somewhere between the ticker tape and the microwave tower, we built a marketplace where time itself became an asset class. Not hours, not seconds. Milliseconds, sometimes microseconds. And when time is money, the richest players don't argue about ideas. They bulldoze physics. The uncomfortable truth is that the market doesn't just trade stocks. It trades priority. And priority, sold in speed, is where the real edge lives. To understand how we ended up in a world where 350 microseconds can decide the winner, we have to leave the shouting pit and step into the server room. The floor used to be messy and human. A specialist with a notepad, a nod, a shout, "Sold!" And a scribble decided who got filled and at what price. That system had plenty of flaws: opacity, favoritism, the soft tyranny of who you knew. Then we digitized the pit. Matching engines replaced people. Order books went from paper to silicon. Fairer in some ways. But computers don't hesitate. They don't daydream or check the clock. They sort strictly by who got there first, and perfect order makes delay fatal. The first generation of speed traders didn't write Shakespearean algorithms. They leased fiber. They shaved microseconds off network hops between data centers. They learned a brutal lesson that still rules the day. When you and I see the price, we're already late. There is no single the price. There's the price at your screen. There's the price inside an exchange rack 20 meters from the matching engine. There's the price someone else saw 300 microseconds ago and just arbitraged against you. That gap between what you think is real and what is actually happening inside machines is a business model. We tried to make things fair. We passed rules that said brokers must seek the best displayed price across all venues. Noble intention. But that fragmented the market into a maze of exchanges and dark pools, each with its own microclimate. Price doesn't live in one place anymore. It flickers across many, out of sync by slivers of time too small for human perception, but large enough for code to exploit. The idealists imagined a national best price that protected investors. The realists looked at the map and saw a racetrack. If one venue updates a hair before another, there's a window, tiny, real, where quotes are stale in one place and fresh in another. Exploit the desynchronization, and you're no longer trading businesses. You're trading time zones measured in microseconds. This isn't about insider information. It's about inside position. If you can't make the market smarter, make it shorter. That became the doctrine. Firms pay to co-locate servers inside the same building as the exchange's matching engine. Packets travel meters, not miles. They write to FPGAs, field programmable gate arrays, that parse market data before a CPU would even clear its throat. They compute strategy in hardware, not code. And when glass is too slow because light bends in fiber, they climb towers and fling bits through the air. Microwave networks arc across cornfields and mountain ridges, cutting latitude with line-of-sight radio that beats fiber across long distances. Fiber curves. Air goes straight. In a market where every meter of cable is a tax, proximity becomes a product line. The exchange sells you shorter cables. The speed shop sells you custom network cards. The physics is simple. The philosophy is not. What does speed actually do? Here's the playbook. Suppose a price moves on one exchange. The ask upticks by a penny. Your system sees it first because you're physically closer. You race to a second exchange where that ask hasn't updated yet, buy at the stale price, and flip it instantly at the new price. You don't care about value. You care about clock drift in a fragmented network. Multiply that by every symbol, every venue, all day. That's latency arbitrage. Another angle is queue position. Exchanges pay tiny rebates to anyone posting limit orders that add liquidity, but only the first orders in line get hit when the market comes to them. If you're a few microseconds late, you're providing liquidity in theory and starving in practice. Nanoseconds decide whether you collect a rebate or become a footnote. There's also the secret menu of order types with names that sound like spells. Post only, hide not slide, intermarket sweep. Each has microscopic behaviors that, used correctly, let you jump a queue, flirt with a fee schedule, or reveal where the pool is deepest without diving in. Some tactics are legal but predatory. Probing for hidden size with tiny pings, then stepping in front of it by a tick to collect the spread while that hidden order passively bleeds. Provide liquidity until the very instant it might hurt you, then vanish. The quote was there until it wasn't. If you're thinking this sounds detached from the grand story of capital, you're right. But there's another layer most people never see. Your retail order, sent from a phone app with confetti and a promise of zero commission, often never touches a public exchange. A wholesaler buys the right to interact with your order flow, payment for order flow, wrapped in talk of price improvement. You may get a slightly better fill than the visible quote. You also supply a precious commodity, predictability. Retail flows are steady and mostly one-sided. Funds that rebalance at predictable times are steady and two-sided. ETFs creating and redeeming units are steady and mechanical. The first firm to see the rhythm doesn't need to predict the economy. It needs to anticipate the next packet. That's where the richest seam lies. Not just speed to a stale quote, but speed to information about flows. It's not illegal front-running. It's lawful statistical inference. Quiet, consistent, boring. That's the point. Of course, nothing built on speed is stable when the ground shakes. In calm markets, quotes look deep. The order book glows with resting bids and offers. Then a shock hits, an unexpected headline, a fat finger, a feedback loop. Algorithms yank orders in unison because they were never there to be heroes. Liquidity goes from ocean to puddle in a heartbeat. Prices gap, then snap back. If you were the slow hand pressing a market order in that window, you didn't participate in price discovery. You donated. There are darker tricks too, some legal, some not. Flooding the pipe with messages to clog competitors' systems, placing feigned interest, spoofs, then canceling before execution to move the market a tick, deploying a change and watching losses compound at machine speed because the test that should be caught it didn't. In this environment, mistakes don't walk, they teleport. Defenders of high-frequency trading have an answer. They say they are the modern market makers. They stand ready to buy and sell, narrowing spreads, lowering costs for everyone. Half a penny instead of a penny matters when you record a pension fund crossing the spread on millions of shares. Competition in speed compresses edges and benefits end investors. There's truth in that, but truth has an asterisk. Ask a harder question. What kind of liquidity is this? Is it there when you most need it? Liquidity that exists until volatility rises is a fire extinguisher that works until there's a fire. When markets are calm, spreads are tight, depth looks respectable, and everyone congratulates themselves on efficiency. When storms hit, spreads widen, quotes retreat, and the average investor meets the reality of conditional liquidity. The predictable flows, the index fund rebalancing at 3:59 p.m., the retail app bursting with buy orders after a meme stock goes viral, subsidize the spread harvesters. Democracy decides who governs. Markets decide who survives. Speed decides who eats. So what do you do if you want markets to reward price rather than proximity? You change the game so first matters less. One approach is the speed bump. Introduce a tiny symmetric delay to all incoming and outgoing messages. It's not a wall, it's a blur. If everyone is delayed equally by a few hundred microseconds, races become photo finishes instead of blowouts, and latency arbitrage loses its teeth. Another design is the frequent batch auction. Instead of continuous time, the venue clears orders at discrete, rapid intervals, hundreds of times per second. Orders arriving during each interval are treated as simultaneous and cross at a uniform price. You shift the contest from micro-timing to price discovery. There are more mundane equalizers too. Standardized cable lengths to the matching engine, randomized port assignments, fewer and simpler order types. These aren't anti-technology, they are pro-market. They aim to turn speed from a private tax into a public good. Even with those designs, milliseconds matter because of what they unlock. The right to see, infer, and respond to breath before anyone else. This is where the smartest shops quietly live. Retail flows arrive in neat, consistent packets. Execution algorithms from institutions telegraph their intentions and patterns. ETF arbitrageurs must create and redeem in ways that surface repeatedly. If you sit at the front of the pipe, you don't know the future. You just learn the present, a blink ahead. And in markets, the present is a gold mine if you can be the first shoveler. Alpha decays from milliseconds to seconds like heat from a spark. The closer you sit to the spark, the more warmth you harvest before it fades. And this isn't just a New York story. Wherever markets went electronic, futures in Chicago, equities in London and Tokyo, FX venues in London and New York, crypto exchanges stitched together by bots, speed followed. The details change, the physics doesn't. Co-location racks bloom near matching engines. Specialized order types proliferate like mushrooms after rain. Fragmentation creates seams, seams create edges. Edges accumulate to fortunes measured not in decades, but in packets per second. What does this mean for anyone who isn't building microwave towers across prairie grass? If you're a day trader at home, you're fighting a jet with a paper plane. Your opponent isn't smarter than you. It's closer than you, wired tighter than you, and less sentimental than you. The price on your screen is a promise. The fill you get is reality. If you're a long-term allocator, your enemy isn't a particular firm. It has a set of frictions you can etc. slippage that spikes in stressed moments, a liquidity that thins exactly when you need to move, and the monetization of your predictability. The market rewards those who refuse to be a metronome. If you must move size, don't be obvious. If you can avoid it, don't be the predictable rebalance at the predictable time, on the predictable day. The sharks have calendars too. Use limits thoughtfully. A market order in a squall is a prayer without a god. Spread your tactics across venues and times, not because one is pure and the other corrupt, but because you shouldn't feed the same pattern to the same mouths on the same schedule forever. In markets, originality is often nothing more than refusing to be boring in public. Zoom out further. Capitalism promises reward for insight, for bearing risk, for allocating capital to productive use. Speed promises reward for physics. The two can coexist, but as milliseconds dominate, the center of gravity shifts from understanding businesses to out-engineering cables. That is not conspiracy, that is policy. We chose it. We sold priority, we priced distance. We monetized time, and as long as time can be bought, someone will buy it. We tell ourselves we have neutral markets while selling front row seats to anyone with enough money to lease a shorter line. It's a circular mirror. The market sells the very thing it claims to neutralize. Does this mean speed is evil? No, speed is a tool. It tightens, spreads, and calm seas. It enables electronic trading in global markets. It provides constant quotes when no human could keep up. But tools don't exist in vacuums. A chainsaw can prune or destroy depending on who's wielding it and why. The goal isn't to ban speed or to pretend you can slow the Earth's rotation. The goal is to neuter speed where it taxes the many for the benefit of the few, to draw a boundary between engineering feats that improve markets and engineering feats that scalp them. There is a deeper irony here. The guardians of the old floor often traded on relationships and whispers. That world could be clubby, exclusionary, a theater of insiders. Electronic markets promised a cleaner stage where the rules were visible and the matching engine had no friends. In truth, the new stage introduced a different hierarchy. Not who you drink with after the close, but where your rack sits relative to the machine that decides the price. The accent didn't vanish. It changed dialects, from human connections to machine connections. We replaced the wink across a pit with the wink of a link light. And yet, there's something clarifying about all this. Speed didn't corrupt markets. It revealed them. It showed, in uncompromising detail, what continuous time trading actually means when distance and time are measurable and purchasable. It forced everyone to confront the difference between price as a number and price as a process. Markets aren't a page of quotes. They're a river of proposals, deletions, and matches, most of which you never see. The world on your screen is a summary written after the fact, translated from a language of packets into a language of glyphs. If you mistake the glyphs for the river, you will always be the last to know. So the next time you hear a speech about fairness, remember that fairness isn't a slogan. It's a timestamp. If you want to make markets more just, you don't scold the fastest runner. You redesign the race. You add tiny delays that everyone shares. You batch orders so priority goes to price, not proximity. You simplify order types so the manual reads like a market, not a magician's crib. You give away less of the public's edge by selling fewer private loopholes. And then you live with a hard truth. Even in a better design, someone will find a seam. That isn't failure. That's the nature of a complex system where intelligence and incentive are always in dialogue. The most important choice doesn't belong to regulators or technologists. It belongs to participants deciding how to behave inside the system we have. You can refuse to be predictable. You can acknowledge that the quote you admire is a proposal and that your execution is a negotiation with a machine who has no idea who you are and no good reason to be kind. You can abandon the fantasy that your home rig can consistently outclick a room full of engineers in a building you'll never access. And you can demand better designs without demanding miracles, because miracles are just failures in disguise. Here's the part that lingers. Milliseconds really do mint money. They always will, because markets live in time and time can never be perfectly equalized. The question is who they're minting it from. In a fairer design, they mint it from each other. Speed versus speed, inside a cage where the rest of us aren't the meal. In a sloppy design, they mint it from the slow and the predictable. The pension that rebalances like clockwork. The saver who panics at the worst moment. The line between those worlds is thinner than you think, and written in code you'll never see. That's not a reason to despair. It is a reason to be precise about what we worship when we say the market works. Because markets do work. They work exactly as designed. They reward insight when insight has room to breathe, and they reward proximity when proximity is for sale. They punish faith that confuses a screenshot for reality, and they punish arrogance that confuses a micro-win for a moral victory. They're not evil. They're blunt. They will go on with or without you, and the clock will keep ticking at the only speed it knows. So when a politician promises to make markets fair again, smile politely and check the hardware. Ask if the distance to the matching engine still buys priority. Ask if, Best price is a fact for you or just a theory written in a rulebook somewhere. Ask whether liquidity is a friend in calm seas and a stranger in storms. Ask whether the simplest fix, delay, batch, equalize, has been tried and kept. And for yourself, ask whether you want to be a predictable participant in a system that taxes predictability, or a thoughtful one in a system that quietly rewards surprise. Milliseconds that mint money are not going away, but the way we let them mint, who pays the tax, who collects the rent, can change. Design markets that reward price, not proximity, liquidity, not illusions, value, not velocity. When we do, the winners will still be fast, but their victory will feel like markets at their best. A contest of price and conviction, not a drag race through glass and air. If that sounds idealistic, remember that idealism is just realism with a longer latency. The packet can arrive. The question is whether we care enough to send it. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.